Now let us come at the calculation of opportunity cost, because that is one which will help us evaluate the best policy. So what we will do is, basis the policy and the present policy details, we will come out with the expected profit, and we will compare it with the opportunity cost. If we will have invested that amount, we have been given the rate of return. So basis that, we will be able to calculate the opportunity cost, and then we will compare as to whether the policies which are proposed are giving profits which are over and above the opportunity cost, and only in that case we can go for this policy. So how do we calculate the opportunity cost of average investments? So average investment, basically, as a concept, what we have to understand is that if it were not for this policy investment, I would have uh, invested this amount elsewhere and earn interest. So we have to put in the total cost that we are, that is the total outflow or the investment that we're doing in this business, into the collection period. Why the collection period? Because that is the amount of time for which it is blocked, and then we multiply it with the rate of return. So how do we come out with the collection period? We know the accounts receivable turnover ratio, which is given at 4 times. So basically, account receivable turnover ratio will be sales divided by debtors. We know that collection period will be equal to debtors divided by sales into the 12 months basically. So it will be, since the account receivable turnover ratio is 4, so the debtors divided by sales will be basically 1 by 4 into 12, which gives us 3 months. So 3 months becomes our collection period. So based on this formula, that is opportunity cost equal to total cost into collection period divided by 12 into rate of return, we arrive at the 3 opportunity costs. Now we can make the statement which shows the evaluation of debtor policies. So we have credit sales given in all the 3 policies. Then we reduce the total cost other than bad debts, that is basically the variable cost. So we know it is 70% of the sales. Then we have been given the bad debts figure. So by reducing these costs, we will come out with the expected profit, that is 1350,000 for present policy, 15 lakhs for the proposed policy 1, and 15,75,000 for proposed policy 2. Then we reduce it by the opportunity cost that we calculated in the working note. After reducing it, we will see the net benefit. Now all are positive. That means the policy is much better than the opportunity cost of investment. But within that, we find that the maximum benefit is received in proposed policy 1. So our recommendation would be, since the maximum profit is being given by policy 1, we should go for it.